Infrastructure plays a critical role in expanding national production capacity, social welfare, and economic development. Spending on infrastructure engenders a GDP multiplier of 2.45 in the year of the capital expenditure. That is, 1 unit of infrastructure spending generates 2.45 times output. And this multiplier goes up to 3.14 in the next. With an infrastructure investment requirement of at least 8 to 10% of GDP annually, India's infrastructure gap has been estimated at 4.1% of GDP per annum, and this will rise to 5.3% if it is adjusted for climate requirements. Over the period 2024 to 30, it is estimated that infrastructure investment will need to rise to 1.7 trillion US dollars or 143 lakh crore, with about 0.4 trillion US dollars in green investments. Going forward, the private sector will move to center stage for infrastructure spending, especially in energy and transportation. The sources of financing will be diverse, ranging from debt and equity issuances in domestic capital markets to external commercial borrowings and foreign direct investment. Let me turn to another key aspect of India's economy, that is micro, small, and medium enterprises. MSMEs are crucial to India's economic and social progress. It is estimated that the MSME sector accounts for 30% of India's GDP, 45% of exports, and 62% of employment in the business sector. MSMEs are expected to grow in numbers in the coming years. The overall financing demand of India's MSMEs has been placed at close to 2 trillion. Of this, the demand for debt-based finance is pegged at 1544 billion US dollars, with half coming from those that prefer financing from informal sources, and they also include some financially unviable enterprises. That leaves a debt demand of 819 billion US dollars, of which currently 289 billion is met by formal creditors like banks. The remaining unfulfilled demand of 530 million US dollars makes up a huge addressable market for banks, fintechs, and NBFCs.